All right, so let's get started. Uh, Barron's, I'm sorry, Bloomberg's economics group feels there's a 100% chance of a recession in the next 12 months. Their survey of 42 economists think there's a 60% survey, a chance of a recession in the next 12 months. So I find it interesting that even inside you have a 40% swing in how people are thinking about what's going on. So I want to talk a little bit about a recent report from the IMF on their global financial stability, talk about what big money is doing in a Barron's poll that they put out this weekend, and then give our thoughts on where we would be taking advantage of the opportunities today. So let's start with the punchline. I think we're going through one of the most significant adjustments in the markets we've had in over a decade. And it's really goes to the very heart of it is moving from zero interest rates up, but also the fallout from that, which includes not just a significant and very rapid move up in rates, but also a strengthening of the dollar and the beginning of quantitative tightening from reducing the balance sheets of major central banks. And then that's leading to a revaluation across all asset classes. So that's a big change we have to really get our mind around. Second is that the Fed is really focused on inflation first and foremost, even if that means, creating 1 million more people unemployed. I think they would do that because they believe they have to stomp out inflation once and for all. The question will become, do they have the wherewithal to do that in the face of a global recession or not? Or do they ease off? That's really what is laying out there. And then I think the big issue for all of us is we're going back to fundamentals mattering more than central bank policy and more than fiscal policy. So we're going back to the fundamentals of investing and what's your outlook for the company's earnings and corporate profits and their ability to manage pricing in a difficult environment. This is a very big change where the opportunity set's narrowing considerably. We still think the U.S. is the best place to invest, and that's backed up by the big money poll, which you'll see in a minute. But I also think if you really want to figure out in a period of heightened uncertainty where you want to make money, then follow where governments and corporations are going to be spending and where they tell you they're going to be spending. So it's going to be on productivity improvements. It's going to be on infrastructure for the governments. It's going to be on digitalization and electrification and lowering healthcare costs. So if you focus on where the opportunities are, you don't have to be as caught up in the short-term volatility and think about where money's going to be earned over a reasonable period of time. And I'm not talking about years, I'm talking about 12 to 18 months. So let's jump into the IMF report. And this shift from QE to QT, to me, is the biggest change we've had to face. And it's going to have a lot of people off kilter. Central banks have been aggressively hiking. You can see the blue line is the emerging economies, and they got ahead early in raising and doing a monetary tightening. The orange is the advanced economies. You can see they were much slower in how they moved, but also starting to pick up the pace. And you'll see them continuing with the US and Europe, probably doing 50 to 70 basis point hikes for a couple more periods. The other thing that I mentioned, assets are being revalued, and this is just a snapshot as of October. You can see the both bond and equity markets, domestic and foreign, have gotten hit quite hard, and there hasn't been many places to hide out in this period. So this revaluation is going to be quite painful, but there may be some more to come, but you're not going to be able to pick the bottom. I think the other issue that's going on is the central banks are taking liquidity. We put so much liquidity into the system. I think the USM2 was up 30% last year. It's only going to be rising at about 4 to 6% this year. So as liquidity has come out of the market, which is the blue line here, and you can see the tightening of conditions and the decline of liquidity, you also see the increase in volatility with that. I think those are going to be two characteristics we have to keep a close eye on as the Fed reduces their balance sheet. That change that they had was they were buying 120 billion of bonds, and now they're selling 95 billion of bonds a month. So almost $250 million swing on a monthly basis, or over two and a half trillion a year of change. So that's a pretty significant tightening of liquidity conditions, something to keep an eye on. Further tightening conditions globally is the strength of the dollar, which we've talked about quite a bit. This just gives you a sense of how it's been moving up both in the advanced economies and in the developed economies. And what that's leading to for a lot of the emerging markets is much higher borrowing costs. And as you can see, that spread in the between high yield sovereign and investment grade sovereign is pretty significant. And unfortunately, more is moving into the high yield area. The other big risk is the inflation risk that we know, which is weighing on all those other areas. And this just looks at the probability of a 3% or less, which is in the blue, or 3% or higher inflation rate 5 years out, which is in the orange. And clearly it's looking at about 60% believe will be under 3% in the US, about 50% believe it will be under 3% in Europe. And then in the UK, only about 30% believe they're going to be below 3%. So not a great outlook, but if it's close around 3, we can live with that. If it's on the 5 to 6% range, then that becomes really dicey for us. I think the other big area that we're going to start to see some real pain in is the housing market. You're seeing it already in the US and China. We know the story there, but you've had a potential declines over the next 3 years. They're projecting a 10% decline in the US and in the advanced economies. And if you think about that potential, housing makes up about 28% of consumer net worth in the US, but in China, it represents almost 60% of consumer net worth. So a 23% decline there could be pretty significant. And we already know some of the challenges that China has in their housing market. And does that risk spill over into the bank market there is a question to keep an eye on. I'm not saying that they are going to tip over or not, but it is one of the areas of risk. And with slowing growth and other challenges in the housing sector, that could really have spillover effects on the global economy. You've also seen money flowing out of the bond market, out of the emerging market bond funds, which tends to flow back into dollars, which means you're strengthening the dollar and weakening these currencies, making it more expensive to borrow. I think that's one of the challenges that we're seeing here, and it's not particularly worse or better than the other periods, but directionally it looks like we saw in earlier periods. Not a great look there. So switching to what big money is doing, and this is a poll from Barron's this weekend, and I thought it was fascinating. 40% are bullish over U.S. equities over the next 12 months, with 30% neutral and 30% bearish. What I found particularly interesting is they're 40% are positive over the next 12 months, and only 16% believe we've bottomed. So I think that speaks to the fact that we're going through a bottoming process, and they are seeing opportunities born out of the pullback that has been very significant. And I think we think about the market as one thing, and rather than think about it as segments of the economy that are reacting at different times to different factors. So Ed Yardeni believes we're in a series of rolling recessions in the US, so that you won't have a big bang. You've already had it going on in different areas, different segments of the economy. I think if you look at it that way, you'll start to see different opportunities picking up in different areas at different times. They asked the big money managers what they think their biggest risks are for the market the next 6 months. And it's obviously rising interest rates related to inflation, but hard to find a footing on price earnings multiples until you get a sense of where interest rates are going to be, followed by a recession. And ironically, most corporate executives believe we're well on our way to a recession, but they must feel they can deal with it a little bit better. I think the big issue is going to be in getting a lot of headlines over the next couple of weeks with earnings season is the disappointing corporate profit levels. Although it seems like a lot of companies are pre-announcing to manage their expectations down and then beating on their revised expectations a couple of weeks after. But I think corporate profits are going to be one of the big issues, particularly with for multinationals with a lot of foreign revenues. They asked which asset class do you consider most attractive today, and they focused on equities followed by cash. Fixed income is becoming much more attractive, particularly on the short end. If you can get 2 years at 4.5% or 4.4%, after being at zero for a long time. That's a pretty healthy area. We're actually at ARS more favorable on commodities than the rest of the world is, but we take a bit of a longer term view. I think it's interesting that they share our views, which markets will perform best, with the US being our most favorable market, followed by the emerging markets, where we think Europe and China are well along their way, if not already in recessions. So I thought this was really interesting. They asked where they thought the following markets would trade as of June and as of the end of next year. And if you look at the bearish number from last night's close, which on the S&P, which was 3716, versus where they're projecting on the bearish side for 3363, you're looking at a 10% downside to the market for over the next 6 months. Wouldn't feel great, but not particularly the wipeout that a lot of people have been projecting. But if you look at the upside from it, it's also pretty significant, going from 37 to 42. It's a 13% increase just over the next basically 9 months. But if you go out a year, you're looking at a pretty healthy returns on the market going out for the most bullish area. And if you look at even in the bearish side, still not an awful period, thinking that we're going 5 quarters out and seeing a slight decline from, or actually an advance from where we are today. So I think it's interesting if you can get past the short-term noise and step back from the media and all the short-termism that exists in the markets and in the media today, and think about the opportunities and look out. This is not a lot of the pain's been put in already, and this is not the worst case for us to be looking at. So where are we putting our money to work today? It's still on the themes where governments and corporations are putting their money, in consumers. So the electrification, the digitalization, national security, which is food, energy, cyber, and military security. Biotech and others that are lowering healthcare costs has got to be a big part of that. And then special situations where we have a number of companies in a 30 stock portfolio. We have at least 4 companies that are going to be buying back between 15 and 30% of their stock annually over the next couple of years. So very healthy opportunities hidden inside the broader market. So Mark, I'm going to stop there and open up to questions, comments.
Great, thanks. Usually give me like 5 seconds of transition there, but you jumped right into it.
Yes.
All right, questions, comments?
Thank you, Stephen.
You're welcome, Mike.
Thank you too, Stephen. Any questions, comments?
Yeah, Stephen, I know you addressed this on a former call briefly, and you were talking about Lockheed Martin and Raytheon, sort of the epicenter of what's being used in Ukraine, if you want to look at it that way. The stocks have performed as if this whole situation didn't even exist. Do you have any view on that?
No, I don't actually. I'm not particularly surprised. In Raytheon's case, they're half commercial aerospace as well, which has not been a booming area. It's setting up to be a very nice area, but it hasn't been a great area for a while. I also think ESG is part of why these stocks haven't done better. They kind of fall into the anti-ESG camp, even though you could argue that if you're in the Ukraine, you're viewing it as very socially responsible and very good governance if you have a good military system with the right equipment. But I think that's part of what's weighing it down. The other issue is it's less than a 2% weighting defense in the S&P. Aerospace and defense is about 2.6%. So it's never really that big a part of somebody's portfolio. We just think they're very solid companies that will continue to do well, and they're really a scarce resource. And as NATO has to pick up their spend, we think they should start to do better. I think on Lockheed's case, I think their issue is a bit of a different one in that, the F-35 has been a bit of a thorn in their side for quite some time and has lost a lot of investors along the way on that one.
Other questions, comments? Hi, Wanda.
Yes, I apologize for my voice. Stephen, do you see any changes in the approach to the nuclear energy and the new developments in nuclear in the light of the latest priorities?
I'm a little surprised that Europe isn't embracing it more quickly right now, but and I'm surprised Germany cut their nose to spite their face the way they did in that area. But I think it's got to be a part of the solution going forward. I just don't know how big it's ever going to get because of ESG. And I'm not sure that that's right.
By the way, William Dahl is bringing a speaker, what he calls a fourth gen nuclear out of the Netherlands to the New York event. Wanda, I mentioned your name to somebody focused on governance. They may be reaching out to you. Other questions, comments?
I've got a thought.
Yeah, Joe.
Certainly, I can't argue with the data of the polling. I guess my reaction is that I'm going to speculate that the folks that were polled have never experienced the markets we're likely to be in. And I think that's the lion's share of the people that respond to that poll, and my guess is largely been in the positions they are in for the last 10 years, maybe 15, but certainly 10. And they're probably ill-prepared to understand what's actually going to happen. And I think that taints there's a bias in their calibration as a result of that.
It was interesting when you looked at some of the other numbers, Joe, that they were closely aligned with what you'd see anywhere on the street in terms of what their growth expectations and their inflation expectations are. So I think you're right on that. And as you know, and people like Todd Rupert know well, we've never really had a QT of the magnitude we're going to go through. So there's really nobody who's invested in the environment we're going to be investing in going forward, which I think the actual tightening is not getting enough focus from the street in its impact on liquidity, and also what it means when the dollar is as strong as it is. We're losing some of our big buyers for treasuries. The Japanese don't get the carry trade working right now, and China doesn't want to do it, and other countries need to sell dollars to strengthen their own currencies. So there's some distortions that are going to be coming that I believe most people aren't prepared for. So I agree with that part fully. And I guess for the rest of it, we're all going to have to see who's right and who's wrong in the post facto review on the numbers. But for me, what's interesting, Joe, is that the downside projection isn't as great as people are thinking, and I thought that was more of the surprise to it, not the upside.
Yeah,
Todd, do you mind if you were mentioned? You have a view on where we are today? I haven't seen you in a while.
Yeah, I apologize. I've been out of operation. No, I agree with the comment that I think that was an astute comment that the people that participated in the questionnaire that Bloomberg did probably have not been around a long enough time to see what we're going into. It's scary out there. Let me make just two comments that were made about Lockheed Martin and nuclear. One of the areas of Lockheed Martin that accounts for about a quarter of the activity of the firm is Lockheed Martin Space. And Lockheed Martin Space, Raytheon just launched the satellite in partnership with Firefly. Lockheed Martin has yet to do that, and they're going to be doing that with ABL out of Alaska, and then also they'll be doing that out of the Shetland Space Center, where I'm on the board next year. And I think that that's going to have a powerful impact on the stock once they're able to get that done. And on the point of nuclear, if you folks haven't seen it, China is now going to be powering their space station with nuclear energy, which has a lot of different ramifications about it. But on the general marketplace, I'm more skewed. I'm very concerned, and I'm concerned about the public markets. They've already gotten hit pretty badly. But I do think that if you look historically, in times of market dislocations and severe economic issues, it's a great time to put money into early stage private companies. And you could see that after the dot-com bust and after the global financial crisis, money invested in those years subsequent to that turned out to have the highest total value to paid in of any other year. So I think it's a very interesting time to put money into early stage venture.
Couldn't agree more. That's what was missing off that chart on preferred assets, and I couldn't agree more, Todd. You could buy a basket of startups if that basket were architected properly, and crush the alpha relative to virtually any of these public market benchmarks.
Yeah,
Agree more.
I want to invest in the Todd Rupert Co-Investment Fund.
I'd be happy. I'm not here to give a commercial, but I could tell you something. It's not about Todd Rupert, but there's an interesting product being launched in the marketplace. But maybe this is an inappropriate time to mention it.
Well,
Todd, a quick question on that, but Mark, before you go on, back in 02, you mentioned 02. Back in 02, I actually was running a VC fund and couldn't raise fund 2, even though everything was cents on the dollar. And do you see in this space today, is there venture capital to actually take advantage of, let's call it, distressed valuations? Is it there?
There's $290 billion of dry powder in the venture industry right now. The money's there. And there's the largest fundraising environment ever in the history of venture capital was last year. And this year it's on pace to exceed that.
Coatue just announced this morning they're launching a $500 billion early stage fund as an example. And we saw Tigers trying to do the same thing. So the folks are rushing into the early stage stuff.
some of them just don't. Some of them, but some of them don't know what they're doing in the early stage stuff. It's different.
Couldn't agree more. I couldn't agree more.
Look, I could talk to Mark about something offline, and if he feels it's appropriate for me to address it, I'll share it with you at a subsequent time.
And Todd, Joe, I feel like it's always the big Brady Bunch because you're right next to each other on my screen. Is putting together an event around a sort of a reset rethink on venture that we'd love to get your input.
Yeah. I'd love to talk with you about that, Joe. I'm happy to participate.
Janan, you've got your hand up.
Yeah, hey, I've been away for a little while, starting more international travel, but
reintroduce yourself, Janan, because you're in the
Sure.
research triangle down there. You see things that people don't see.
Yeah, absolutely. Hi, I'm Janan Glasgow George. I'm an IP attorney, patent attorney with Neo IP, my own practice for 23 years. I have a software company, Patent Forecast. So we track every sector from software and high tech all the way through advanced materials, biotech, aerospace. And we advise a lot of funds. I'm based in Raleigh-Durham, Research Triangle Park, North Carolina. We've seen a lot of very good price on companies raising, even in Series A, maybe in a second one, but seed rounds, very good pricing in all of these sectors, in digitization, the electric power grid, et cetera. And actually the funds don't seem to have a lot of problem raising down here. So we are looking at funds on the West Coast.
Hey, Ty, how are you?
Nationally. But just to mention that we are seeing a lot of quick raises, even July, August. We had a client in biopharma raise 2.3 million in less than 2 months. Very favorable rates. So we're tracking the data. Mark, I need to coordinate with you on how best to share that with the group. But we're hosting a conference on Thursday, my 9th annual IP Futures Conference in Raleigh. And we have funds from Dubai to the US and Mexico who are participating. And we'll be exploring that activity. I'll write a summary of our findings from this conference. And share that with you. Thank you.
Thank you. Look forward to it. So we were going to transition here to talk about what's happening in
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.